This is mind-boggling stuff. It's going to surprise a lot of people. I don't think many people have even thought about this. This is a multi-trillion-dollar trade.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault, the show that goes beyond the headline and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times that we're living in right here. We have exclusive access to experts and insiders. We reveal information and insights you simply won't find anywhere else. Hi, my name is Shane Moran, and as you can see, I'm back in the vault and off the beaches of sunny Costa Rica, and I'll be your host this week for this week's episode. We'll be joined shortly right here by the one and only precious metals expert and whistleblower Andrew Maguire as we pull back the curtains on the intricate world of the gold and silver markets and expose what's really going on in the precious metals industry. So get ready for another blockbuster episode of Live from the Vault, and we'll bring you the knowledge, the understanding that the mainstream media will not provide. You're going to get that right here and right now. And with that, let's head over to the UK and talking gold with Andrew Maguire. Hey, Andrew, as we start, I guess, this week's episode, it seems like these 2 weeks are like 2 months. There's so much going on. But can we pick up the thread from our last market update 2 weeks ago? And really, what's drawing the subscribers' interest is how the paper to physical gold battle that you talk about all the time, but it's really intensifying here. Can you tell us what you're seeing as we head into the end of Q3?
Great to be with you, and great to be with you all. Yes, Shane, this is a great place to start. Let's look at the short-term data. Let's get that out of the way, because there's some major stuff happening, and it rails directly against what the mainstream media are talking about. So let's get that done. But really, let's look at the short-term stuff that set us up for Monday's U.S. market. Obviously we had a U.S. market holiday on Monday, and then we need to look at this significant widening of the paper to physical market disconnect. And Shane, there are some significant supply-demand developments that we're going to look at. And last week's shortened holiday market action began with the UK holiday on the week before, on the previous Monday, thin holiday market trading conditions affecting gold and silver, futures primarily, which we expected to continue until liquidity returned yesterday on the 5th of September after the Monday's Labor Day, the US Labor Day holiday. So let's follow the footprints that drove this heavy action into this first liquid trading session of September that commenced yesterday. It's coming through. It's followed through today. So following a fairly benign PCE print, which was Powell's preferred indicator, he was quite clear about that at Jackson Hole. The Friday politically goal-sought headline non-farm jobs beat was accompanied by a guaranteed downside adjustment, and which is, of course, ignored by the headline algos who just chased the main number. But it was anticipated to be a non-event following the PCE print. So, and bang on cue, while the goal sought headline non-farm payrolls number was yet another headline beat, because it was bolstered by massive amount of part-time jobs, all of which will be, of course, revised lower next month. But what could not be ignored by live traders was the unprecedented 670,000 full-time jobs that have been lost in just 2 months. And this was the worst unadjusted August payrolls since the Great Recession. Now, in summary, the dubious 100% record of politically generated job beats to be followed 100% of the time by a prior downside adjustment had successfully been fooling the headline algos. But this month, these accruing adjustments, as they've built up, finally exposed a full year of rigged data and immediately drove the dollar sell-off and an inverse race into safe havens, including, of course, gold and silver. Now, we have to keep in mind that the Fed has been reliant on strong jobs data to continue to hike their way out of an inflationary hole. But these numbers were an impossible to ignore disaster, immediately evidencing a natural reaction in the foreign exchange and bond crosses. And as far as gold and silver was concerned, with the dollar index plunging and gold and silver spiking higher, something had to be done. And with the Fed already in possession of this non-farm payrolls data days ahead of the Friday release and fully anticipating this steep dollar sell-off, they clearly pre-planned a dollar rescue intervention. And it was no coincidence that the Fed member, this was Loretta Mester, was immediately rolled out on the podium, frantically plate spinning more hawkish comments, rescuing a plunging dollar index, and driving the Fed run, sort of the inverse gold and silver algos into sell mode. So dollar was rising, gold and silver immediately started selling. And that's inverse, really in the sense that if the dollar is higher, the other side of the trade is sold lower, really to finance the foreign exchange rally in the dollar. So there's a cross, if you're long one side, you're short the other. It's as simple as that. However, this is where it gets interesting. Now, with net stable funding ratio compliant first tier, physically deliverable spot gold trading in the live foreign exchange markets, increasingly competing with US treasuries as a first tier asset class, and we've been doing a lot of work about exposing this, it was no coincidence that the Fed once again employed what we call the full court press, or what you in American call the full court press, to counterintuitively intervene in gold as it came within 30 cents of triggering what we'd identified as the safe haven sovereign and central bank sovereign spot gold buy stops. In other words, after we'd seen the sell-off in gold, we'd seen central banks starting to buy the dips, but then also pre-positioning themselves once a certain level was overcome, that they would be buying. So obviously, what we're saying is it came within 30 cents of triggering, and after the several dollar move, of triggering the central bank sovereign spot gold orders. And of course, the liquidity providers have patiently been sitting alongside them at the spot gold equivalent of the COMEX. And I give you the COMEX number, which was 1980.50. And I think that it topped out at 1980.20. So no coincidence that got front run.
Now, that's a lot of drama here now, Andrew. From what you were saying just before we started recording today, this could have been catastrophic for the Fed, who's the only central bank that's net short gold. Can you expand on this?
Yeah, Shane. On Friday, just before the Fed intervened in the crosses, the Fed was, what we're saying is the Fed was just 30 cents away from losing control of gold the next time this level is breached. So keep an eye on it, and it will, watch out above, as the Fed will be hanging onto the coattails of what is a very large central bank, physically driven end of year gold revaluation rally. Now, we're going to explain why in a second, but in the meantime, what an opportunity to stack some physical bullion at these COMEX diluted prices. I mean, look at what we're seeing today. Absolute paper, complete paper generated, nothing to do with the physical market, and incredibly divergent from what we're seeing. It's important to understand the change in gold's behavior versus dollars and bonds. And we've been drawing public attention to multiple bouts of gold rising alongside a rising dollar. And this 50-year paper-centric inverse algo is actually showing signs of dislocating as both paper and physical gold are increasingly sought as a first-tier safe haven asset class. And the last time we evidenced anything close to the scale of such a dollar index gold disconnect was back in 2008, when gold rose alongside the dollar and both began to compete with each other as safe havens. Now, following massive bank failures, this was, and obviously downgrades, that was in 2008, both paper and physical gold were chased into a 3-year $1,200 safe haven rally with inconsequential small pullbacks along the way. And joined at the hip, silver also rallied alongside the dollar index, and that rose $40 as investors exiting bank investments also converted bank withdrawals into safe haven silver. And really, that was when the gold and silver was looked at as, my goodness, I want to get out of risk. Where am I going to put my money? In the bank? No, the banks were going down. So what would you do? You have choices. It would be a commodity. It would be a precious metal. It would be gold and silver. Now, the Fed is now playing with fire. If they insist on walking this rate hike talk, we likely see the bond yield spike higher again, which would almost certainly trigger the pre-warned Jackson Hole, Fitch and Moody's first tier, too big to fail bank downgrades. And if you remember, we talked about them. They're in the sidelines waiting for Jackson Hole. And we've seen hawkish comments. Now, that would open the potential for a concurrent dollar and gold safe haven rally to unfold. Only this time, gold, this time is now a first-tier asset class, unlike when in 2008. However, more immediately, under the deliberately induced volatility that we're witnessing now, we're looking at a more contained, but nevertheless very bullish setup that is structurally very similar to the most recent Fed-induced gold interventions, which actually capitulated earlier than they would have liked back in March of this year. And that is quite recent. And to be clear, we're discussing a wholesale market setup that closely mirrors the structure that followed what was the most recent last major round of Fed gold market interventions. And they similarly, they capitulated, as I say, in March, and that was at $1,818. We talked about this before. Silver was bottoming about at $20. Now, as far as paper gold markets are concerned, there's evidence that an increasing number of COMEX, commodity trading advisors, have recognized that Basel III compliant gold morphed into this first-tier asset class on the 1st of January and are increasingly employing gold as a risk hedge, meaning their cash-settled COMEX, open interest, their casino chips they play with, have become sticky and far less able to be rinsed. And this means that as the COMEX futures markets misprice gold, like they're doing today, net of what can be cash-settled against the muscle memory speculators, the exchange for physical outflows, which is the casino's backdoor, and the related mispriced LBMA gold fixes, as we've seen again today, is evidencing a higher bilaterally settled physical gold price in the real global markets, who are benchmarking a premium over these rigged price fixes. And it has to be borne in mind that these physical deals are deliberately kept off the radar of the ring-fenced CME LBMA supply-demand data. But these physically settled outflows are eating into just one aggregated source of available global physical supply at these diluted cash-settled COMEX-determined prices. There is only one supply of physical gold, no matter what currency you denominate it in. Interestingly, Japanese yen just hit all-time high prices in gold. Why wouldn't it? And as we discussed last time, what most CTAs just don't understand is they've become the cartel's useful fools, likely because, as we say, they're forbidden from even accessing the net stable funding compliant over-the-counter gold markets. But what they do miss is that while the LBMA fix sets the global price, the liquidity providers providing foreign exchange gold market liquidity into the NSFR compliant multi-trillion-dollar over-the-counter markets have to be physically backed. And it's these bilaterally settled deliverable over-the-counter markets where this bullion is being picked off by competing central banks. So this leads us into what is happening outside this siloed world of the Fed-contained CME LBMA gold markets. And it is significantly under the radar. Physical gold is acting as the perfect barter currency for the Russian energy trade.
Hey, now, Andrew, you've been drawing a lot of attention to the gold barter trade all the way back from, I believe it's March of 2022. Can you explain how this has evolved, please?
Absolutely, Shane. In fact, really, when we think about it, this barter trade seems to have slipped off the radar until 2 weeks ago, that is. And following Russia officially pegging a gold gram price to its oil trade, that was back in March 2022. We did so much work on this. And this trade has actually not ceased to function. And because it violated sanctions, was kept pretty much under the radar. However, this trade has just become far more sophisticated and at the margin is now severely expanding the Western priced paper gold price from the higher physically deliverable global South determined supply demand price, where there is a whole different view on gold. And while the blinkered pundits sift through one-sided house-gamed CME generated, we talked about COT data, and then people are hand-wringing, looking at what this bank's doing and what that bank's doing. Under all of that radar, something very important is going on under this deliberately obscured smoke and mirrors COMEX data. Namely, a very large drain of global bullion is headed into the Sino-Russia alliance, and because it's occurring outside the CME LBMA ring fence, it's totally unreported. Now, following the BRICS summit winding up 2 weeks ago, and while the mainstream media, as you rightly say, Shane, they've glossed over the multiple sideline meetings that actually went on in South Africa, no mentions of them. The mainstream media has actually been vocally gloating that no currency agreements were agreed. Yet no mentions at all of last week's meeting that followed on in Moscow, which appears to have moved on to this subject. Now, while Glaziev's option one commodity currency, which was, we discussed this, it was the STR-like currency basket, that was the sole focus of the mainstream medias and, of course, the bloggers. And based on last week's footprints, we have sufficient evidence to discern that option two, which was the gold-backed commodity basket, is actively actually on the front burner. And Russia has the wherewithal and the gold and the energy resources to aggressively drive this gold-backed currency forward. Now, we're not taking sides here. We're talking about gold and as it fits into the global landscape. Now, this all makes total sense. Now, look, the SDR, like basket of national currencies, will ultimately one day, it will come into fruition. But given the current trade balance disparity between the bulk of these BRICS nations, which it is such a disparity, so it can't work. And of course, we see the commodity basket currency is perhaps some 2 to 3 years away from creating the required basket weight formation to actually be equitable.
Now, Andrew, it looks like talking about this, it looks like that the mainstream media has really got this wrong when it comes time to the BRICS alternate currency. They got this threat wrong. Can you expand on that?
Yeah, Shane, absolutely. And as far as the mainstream media is concerned, what they and their narrative masters focus on is how imminent a BRICS de-dollarizing process is. Is it or is it not? And with the BRICS currency discussions looking like a damp squib and no immediate threat to the dollar hegemony, the win-lose narrative has provided sufficient comfort to them to take their eye off Glaziev's golden ball, which is actually indeed in play. And as we indicated a few weeks back, when Glaziev recently outlined his two proposed currency baskets, he made it clear they would serve really two separate purposes. But what has failed to be realized is that the SDR-like currency basket could not be implemented without first establishing the gold commodity price leveler. In order to bridge the immediate chasm is for each member country to accrue physical bullion, and Russia is aggressively facilitating this trade. So the major commodity currency focus is on the second basket, backed by physical gold bullion. comprising of 20 of the most liquid commodities from oil to grain. Now, Russia produces all of these commodities, including gold, which in aggregate will provide a stable index to benchmark a new world currency such as would suit the BRICS Development Bank, all seamlessly settled on the trustless blockchain. So this became clearer last week. So let's look at those footprints. Now, while the mainstream media attempts to delude global markets that any threat to the dollar hegemony can be, so you can ignore it all for now, the mainstream media conveniently ignores the significance of the BRICS summit adding oil-producing members such as Argentina, Egypt, UAE, Saudi Arabia, Iran, and Ethiopia, which means the BRICS Plus now already controls 48% of global oil production. And when Russia takes chairmanship of the BRICS in January, Algeria, Venezuela, Kyrgyzstan will be onboarded, meaning that up to 80% of global oil production will flow through BRICS members. And at the margin, even if a fraction of these alternate flows sidestep the hegemonic SWIFT messaging system, it will most certainly have a major de-dollarizing effect. De-dollarizing is not the BRICS focus, but it serves heavily sanctioned Russia very well, and they are the drivers and the conductors of this gold train. So furthermore, likely under official instruction, but 100% on the Western radar, for exactly the reasons we're just outlining, the mainstream media has either deliberately or otherwise ignored the rollout of Glaziev's gold-backed commodity currency option, and the wholesale market footprints since the Moscow meetings last week back up what we've been seeing and hearing from our Russian gold contacts.
Hey, Andrew, with a potential 80% of the oil markets ultimately being priced by the BRICS members, the potential for expansion of this gold barter trade is in the multi-trillions, is it not?
Yeah, I mean, this is mind-boggling stuff. It's going to surprise a lot of people. I don't think many people have even thought about this. This is a multi-trillion-dollar trade. This is what we're seeing happening right now is all in preparation for when Russia takes over the chairmanship of the BRICS in January 2024. It's only a couple of months away. And the Sino-Russian alliance is accruing physical gold in preparation for this, to power Glaziev's 20 commodity gold-backed currency. Now, Russia has turned up competing. What they've done is turned up competing to get spot gold and futures liquidity. And as we will explain, along with the UAE, Saudi is seeking to ultimately control the bulk of the price-setting mechanisms of pretty much 80% of global oil production. And with Russia being the most sanctioned of all the BRICS countries, it incentivizes Russia to lead the way in looking down the gold, in really just lock down the gold element. You need to power this currency with that, of the current multi-trillion-dollar trade. And that is a multi-trillion-dollar trade. So is the dollar is, gold is, and oil is. I mean, all these things come together. It cannot be ignored. And gold will become the beneficiary of this multi-trillion-dollar trade. What escapes most pundits is that the only competing multi-trillion-dollar foreign exchange currency versus the dollar is multi-trillion-dollar foreign exchange gold. This market is beyond most people's comprehension because they're locked inside the casino. And the Sino-Russian alliance is what it's doing is capitalizing on the fact that foreign exchange gold is now both physically backed as well as a first-tier asset class. Again, something that's ignored. And the footprints are there to see. Despite the ruble significantly weakening against the US dollar, almost to the point when initially sanctions were placed against it, we have for some weeks now been evidencing a consistent spot gold premium being offered by Russia for bullion, significantly over and above that set at the PM fixes, which we've just seen one of. This is also evident in the gold-backed Moscow futures contract. However, these Russian gold premiums really expanded last week. And they're holding strong again this week, very strong. This is no coincidence. So what's going on? It's actually simple. Russia is actively bartering energy for gold and offering a much higher gold price to attract these bullion inflows. Look, this is just the thin end of the wedge, serving two main purposes, really: attracting global bullion inflows with a view to ultimately backing some of the 20 most liquid commodities, all of which are traded between BRICS members, of course, while also serving Russia to swerve sanctions. Now, through our Russian contacts, we've been verifying this is all the hallmarks of a fresh mandate to attract gold bullion flowing into Russia, and notably under the cover of the CME LBMA gamed fixes, which only serves to rinse these spec cartels' useful fools out of their paper positions. These unleveraged physical bullion outflows are sucking leveraged physical liquidity out of the LBMA ring fence into the directly competing Moscow spot gold and Moscow COMEX competing physically backed, I will stress, gold futures platforms. And the footprints are so clear. Despite a severely weakened ruble, as we've said, against the dollar, that is, we've evidenced extremely large premiums being paid to attract bullion into both Moscow futures and these spot live contracts. Now, these premiums have at times been massive. And while Moscow live spot gold consistently trades as an actionable premium to live London spot over the course of the last 2 weeks, Moscow gold-backed futures have commanded as high, get this, as a $41.70 per ounce to the December COMEX futures contract, and has also been directly competing with further out all the way to April 2024 futures, which is trading at a $40 premium to the front month COMEX December contract. Now, think about that. Most mornings in Asia, we see a very conservative $20 to $30 premium to COMEX futures, but these expand into the COMEX pit opens. I mean, I just checked just now, just before we started recording here, we're evidencing a $46.50 premium to December futures. Obviously, the volumes are a fraction of the COMEX flows, but Moscow futures are physically deliverable. And the point is, each ounce of gold that exits the CME LBMA ring fence unwinds highly leveraged paper gold, and it is at the margin that the gold price reset will be driven. It's leveraged. This gold is so heavily leveraged that it's flowing out. And if you think about it, this is not a bad barter for an energy buyer who is forced to stump up dollars anyway for energy at the quoted market price. So oil, whatever it might be, gas. Instead, what they do is simply EFP, the paper diluted COMEX gold, into the NSFR compliant deliverable dollar denominated spot gold, or you just buy foreign exchange spot gold price in dollars anyway at the COMEX influence swap price in London. But what you're doing is you're keeping your bullion purchase to sizes below the size level that would result in large discoverable bilaterally settled premiums. Then what you do is you exchange the cheaper dollar priced gold bullion for Russian oil, energy, grain at a higher dollar denominated price in Moscow. So this ends up as a discount for the energy and inflows of physical bullion to back a larger plan, BRICS-backed commodity currency. That's what's going on. And also, while Moscow spot is consistently trading at a $1 to $3 premium to London, we've seen Moscow spot commanding up to $10 premiums per ounce to spot. And that's a T. Bear in mind that London spot is T+2 deliverable. It has to be settled. It's backed by physical. And bearing in mind that once secured, all of these 2-day delivery flows are off grid. And this bullion is being paid to Russia in exchange for energy. And feedback points to this bullion activity actually being directly related to the gold-backed commodity currency to be officially launched before or after Russia takes over the BRICS in 2024. So it's happening. And so basically, what we're saying is this trade is underway. And also, as Glasdiev predicted, the trade is attracting multiple brokers to facilitate this trade, providing an increasing depth of necessary liquidity to fund what will ultimately be to serve 80% of the multi-trillion-dollar energy trade. As I say, the trade is underway. Now, Glasdiev reports that this currency boilerplate has already been largely agreed by BRICS members. And we did mention India and China really officially watching from the sidelines. However, feedback from our good contacts in Russia still indicate no opposition and a readiness to participate. But obviously, they don't want to sort of fall on the wrong side of aggressive US sanctions at this point. India is very worried about it. China is trying to bat that away. But of course, they're going to gradually adopt this currency. By next year, the BRICS conference, which is Russia presiding, will likely formally announce these already developed new currency units have become, as they put it, the new method of settlement in the international trade between BRICS countries. That's what it was labeled as. And this is undoubtedly Glasdiev's option to gold-backed trade being implemented right now. And the process looks to have stepped up following meetings in Moscow last week. And currently, this trade is largely related to energy, but looks to be in the process of pricing some other Russian-priced commodities, including grain, to Africa. Notably, all of this activity is occurring outside the CME LBMA ring fence and significantly skews the published data, but will severely impact paper-diluted Western gold market liquidity. So really, if I want to sum this up, what we're saying is, in summary, the mainstream media is not ready for the launch of Glasdiev's gold-backed new world economic currency. And while they obsess that the dollar is king, BRICS Plus is not focused on destroying the dollar, simply adding a competing gold-backed currency to facilitate settlements of a very large component of the current US dollar denominated global commodity trade. It's that simple. And while Russia currently provides a large energy discount to attract a bullion, even allowing physically backed futures to lock in very large trade at settlement discounts as far out as April. Now, once the currency has sufficient liquidity, it will set the global price. The inflationary aspects for the Fed and the Western dollar denominated commodity prices will be massive. We talked about this before. And at the margin, the increasing demand for gold to back up this multi-trillion-dollar trade will increasingly raise the offer price of gold in the global markets and place the wrong-footed Fed further on the back seat. And as we've also identified, this energy trade is enabling Indian buyers to step up in circumventing the CME LBMA ring fence while taking advantage of the gamed global PM fixed prices that benchmark real physical exchanges outside the LBMA. Liquidity providers also report off-grid settlements bleeding into all the physical exchanges benchmarked at these two COMEX-diluted PM fixes. So given the consistent spot premium offered by Russia, this lack of Asian market flow through the rigged LBMA London fixes that we've just seen just now is misinterpreted as a lack of interest in gold, whereas these flows are and will increasingly be facilitated through other channels as they evolve, of course. So first-year market-making banks will be aware of this, whereas the Fed, the only central bank still short gold, is once again wrong-footed. Is it really any wonder every participating central bank except the Fed is openly and surreptitiously accumulating physical gold? And as Tom Lungo rightly points out, and I read something about him with him the other day, it was really good. He says, yeah, quite right, Russia's at war with the West, so of course Vladimir Putin will talk his book on de-dollarization. He is the point man on the BRICS being anti-dollar. But according to the latest data from the SWIFT RMB tracker, there is no currency that has lost more ground in the global trade than the euro. And in just over 2 years, the euro has fallen from 39.5% of global payments outside the Eurozone to just 13.6%. Now, we also see this as the US price influenced European gold markets, influencing them tremendously, which are also evidencing a drain of physical into gold into Russia. So talking about a drain on physical at current prices, guys, how much physical do you own?
All right. Thank you, Andrew Maguire, for talking gold. And remember, to our Live from the Vault community, buy physical and make sure it's backed 1-to-1, and understand the difference between what Andy affectionately calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. And there you have it. That's all we have for you today on another fascinating and blockbuster episode of Live from the Vault. Now, please help keep spreading the word about this channel by hitting that like button there if you haven't already done so. It takes you 1 second. Share this information and be sure to subscribe if you haven't already done. And if you want to be notified in real time as each episode goes live, just click that bell and we'll do just that. And with that, we will see you next time right here on Live from the Vault. See you then.